what I'll talk about today is primarily about the Great Depression and broader implications for economic crises, including our current recession. So I'm going to start out by just noting that major depressions, major crises, they're kind of the ultimate economic whodunit. So, we've all read, one or more than we care to admit whodunits in the course of our lifetimes. And in a great whodunit, there's always an important person that's something bad happens to, and there's a cast of interesting suspects, and it's very hard to figure out who done it. And crises and depressions have sort of the same feature. There's an important murder. In the case of a crisis or depression, an economy gets leveled, sometimes for a very long period of time, and there's often a lot of potential contributing factors, and it's hard to understand and decipher the relative contributions of all those factors. So I'll just start by saying depressions and crises remain a big challenge for economic theory, and particularly in economies that typically function well, such as the United States or other OECD economies. And the two questions I want to focus my talk around are, why does a good economy go bad, and for so long? I'll show you some data in a few minutes that will show that the Great Depression in the United States lasted well into World War II. And the second question I'll try to focus the talk around is, what causes them and really what prevents a rapid recovery. In the United States, following recessions, we usually have pretty rapid recoveries. In the Great Depression in the 1930s, we didn't. And today, many people are worried we're not going to have a rapid recovery from our current recession. So I'll try to touch on those topics as well. In terms of where I'll be going, for main themes, the Depression was more than a decade-long event, and it was largely due to what economists call market failures, the failure of supply and demand to bring about what we call equilibrium. And what I'm going to argue is that these market failures were the result of well-intentioned but badly designed policies on the parts of both Presidents Hoover and President Roosevelt. An implication of that argument is going to be that the Depression in the 1930s would have been much less severe and much less protracted in the absence of these policies that, in my opinion, led to market failure. Okay. In terms of background for the presentation, I'm going to draw on two academic papers I've written. One is in the current issue of the Journal of Economic Theory. Another is a paper I wrote with Hal Cole, who used to be here at UCLA. We lost him to Penn. That came out a couple of years ago. And you can find these papers on my website if you'd like to read more about those. Okay. So I'm going to start out by just talking about some facts, and I think at least some of you will find these facts surprising because they're not the ones that you've heard about when people talk about the Great Depression. So what is sort of the textbook view of the Great Depression? Well, it started out as what many people call a garden variety recession, and that the Federal Reserve, through a series of mistakes, let the money supply fall and let banks collapse, and that monetary forces and banking collapse is what turned this garden variety recession into the Great Depression. And that there was substantial economic recovery after 1933. So that is what I would call the baseline textbook view about the 1930s. So I'm going to show you some data that contrasts with those views. And the first piece of data I'll show you is that the Depression was not a garden variety recession. It was not just a small decline with 1 or 2 or 3% drop in employment, which is what we typically see during what we call garden variety recessions. Instead, employment fell very rapidly, and in fact fell long before the fall in the money supply and banking collapse or banking panics happened. So let me just show you that right now. This slide shows hours worked in the manufacturing sector and the money supply. And I start in January of 1929, and I go up through the fall of 1930. The reason I stop in the fall of 1930 is that in late 1930 is sort of the first banking panic. that economists talk about. Now, this banking panic was, in my opinion, a trivial banking panic. It impacted essentially only Memphis, Tennessee. But not to debate that, I'm just going to look at these data up through the fall of 1930 when there's no banking panics whatsoever. And what the graph shows is that through most of 1929, things were pretty stable. The red is manufacturing hours, and I've indexed these to be 100 in January of 1929, and it's around 100 or slightly above 100 throughout that period. And the two green lines are different measures of the money supply. M1 includes cash and demand deposits. M2 is a broader measure of the money supply. That includes M1 plus savings accounts. And what you see is that the Great Depression starts in the fall of 29, and immediately it's really quite severe. So in other words, by about 6 months into the Depression, so I go to about mid-1930, manufacturing hours are already down 20%. Now, to put this in perspective, hours worked in the current recession, which is now about 2 years old, have fallen much less than this, about 10%. Now, what about the money supply? And this is, for those of you familiar with Milton Friedman often argued, gee, the Great Depression was all about the Federal Reserve making mistakes and letting the money supply fall. And about a year ago, during last fall, when there was all that crisis in financial markets, when the major programs of the Federal Reserve under Ben Bernanke, who's read a lot by Milton Friedman, they said, we're going to make sure the money supply doesn't fall because that was the problem in the Great Depression. Well, not much happens to the money supply early in the Great Depression. They're down maybe 1 or 2%. So what I want you to take away from this picture is essentially that something else happened in late 1929. Not the money supply, not banking panics or bank failures, but something else happened that initiated the Depression, and it was big. You know, what or who was that? This theme of a whodunit I'm going to come back to a number of times during the talk. But when we want to blame what was the start of really this devastating episode, so a year after the Depression starts, not even a year, there's a 30% drop in hours worked. I mean, this is already an economic catastrophe. It gets worse after this. Not all that much, but it's already very, very bad. So when we think, you know, who did this? What did this? It's not the money supply, and it's not banking failures. We already were in a full-fledged Great Depression before any of that stuff happened. So I'm going to think about that as a clue. We're going to be looking for something that happened well before monetary or financial forces. And another clue is I'm going to look at the distinction between the industrial sector and the agricultural sector. Now, at this time, both had about the same share of employment, close to 30% share of employment in both industry and in agriculture. And the picture I just showed was the industrial depression, employment falling substantially in the manufacturing industrial sector, but there's essentially no fall in employment or hours worked in the agricultural sector. So the second clue I'm going to think about is that whatever this big factor was that started pushing the economy off the cliff, it was very sector specific. It was very asymmetric. It hit industry, but it didn't hit agriculture. Okay, so if money and banking issues didn't start the Depression, so what did? Well, where kind of standard economic thinking takes me is to think about what I'm going to call a labor market failure. And what we mean by a labor market failure is that, you know, there's a supply of labor, there's people that wish to work, you know, they might wish to work more or less depending upon the wage, and there are hires of labor, there's businesses out there that wish to hire workers, more if the wage is low, less if the wage is high. And both microeconomic, that is individual and firm-specific data, and macroeconomic data both point out a huge labor market failure, the failure of supply and demand to come together and create equilibrium, and that starts in late 1929. And there's an economic historian at Duke, I believe, named Curtis Simon, and he's done some fascinating work. And what he did was he went back to the New York Times. And back in the day, there not only were help wanted ads, where businesses are saying, okay, we're hiring a certain type of person, but there were situation wanted ads, where I can place an ad and say, okay, I'm a 52-year-old economist looking for a job. Luckily, I have one right now, but that's what these things were. I'm a person of a certain age, here's my experience, and I'm willing to work at $5 a day or whatever it was. Now, this is really important because these situation wanted ads give us evidence on what the supply price of labor is. That is, the wage rate at which individuals are willing to work. And before the Depression, what Simon found is that the supply price of labor, the wage at which people were willing to work, and what the wage that actually was paid were very similar. They typically were within a couple of percentage points of each other. But once the Depression started, after late 1929, something very different happened. And what you see is that the supply price of labor falls 30% below the wage that's actually being paid. So in other words, I'm taking that ad out and I'm saying, hey, I'm a worker of a certain character, here's the kind of work I do. I'm willing to work at $5 a day. The people that had the jobs that I was trying to get with the same characteristics, same years of education, experience, training, and ability, and so forth, to the extent that we can estimate those things, were receiving a wage 30% above that. So what that tells us from an economic perspective is that the wage was too high in the sense of achieving clearing of the labor market, that is, demand and supply coming together. Instead, with the wage too high, businesses aren't going to hire very many people. They're not going to have very many people working for them, and there'll be a lot of people out of work willing to work, and in fact willing to work at much less than the wage being paid. So in other words, we're in this room, we're all working for $10, and there's an army of people outside who are observation equivalent to us, roughly speaking, to say, hey, we'll take a 30% wage cut and replace all these people. So that just sounds strange from an economic point of view. What factor was keeping the wage up so high?
Quick question. Point 3 there. What do you think, or what does Simon think, was the representative quality of those situation wanted advertisements? In other words, were they kind of like a good random sample of all aspects of the industrial economy, or were they biased in some way that would make them not representative?
Yeah, so there can be sample selection effects in these types of situations. And Simon did a pretty careful job of trying to compare differences in human capital in workers before and after the Depression started. And what he comes away with is that the possible biases that might be reflected in sample selection bias or a non-random sample don't seem to be quantitatively important to account for this 30% difference. Now, that's not to say that obviously all these adjustments are imperfect, but it seemed to me, and it seemed to him and others who've read this paper, that the explanation doesn't lie with those types of biases. That's an excellent question, but he didn't find evidence that would support that as the leading candidate. Okay, so. Now that's kind of individual, microeconomic individual data on the supply price of labor. There's also macroeconomic data, aggregate economy-wide data, that also gives us the same picture. Now to see that, kind of basic economics essentially tells us that an individual is going to equate the marginal benefit of working to the marginal cost of working. And we call that in economics something called the marginal rate of substitution. I won't go into that in a great amount of detail, but what that tells us is that when wages are very high, people should tend to work more. And what we see, and also be consuming more. So high wage periods should be economic booms. Wages are high, prosperity's here, we're going to work more, and we're going to consume more. The Depression is the exact opposite. Wages are high, but we're in a depression. Consumption's low, and not very many people are working. Again, that feature, why aren't people working more when the wage is so high? Or alternatively, why didn't the wage fall so that more people could have worked? Again, that jumps out at you from this data and from interpreting the data using kind of basic economic reasoning. Now, what about the agriculture sector? Well, in agriculture, that sector wasn't depressed in the sense that employment and hours worked in that sector actually rose a bit during the Great Depression. Now, some of you might think about, what about the Dust Bowl? That was a few years later. But in 1930, 1931, 32, agriculture employment actually rose. And, at least from my standpoint, not coincidentally, the agricultural labor market looked a lot different. In particular, wages didn't rise substantially. In fact, nominal wages, or what we call the dollar price, the current dollar value of wages, they fell a lot. Wages fell a lot. So again, I'm going to come back to this juxtaposition of industry, I'll get that in a second, industry having substantial depression with wages far above normal, and agriculture not having a depression but having wages fall.
Wait. Is 1929 the right base year to study agriculture from? I mean, again, the textbook story is there's an agricultural collapse starting in 26, 27.
Yeah, there wasn't much change in agricultural employment between 26 and 29. There was a decline in the relative price of agricultural products, but there's not much change in employment at that time. Okay, so here's a picture I took from one of the papers I pointed to earlier in the talk, and there's a picture of what I'm going to call real manufacturing wages, which is the solid, and then the dashed is nominal manufacturing wages. So nominal manufacturing wages are wages just measured in dollars. And the distinction between the two comes about from changes in the value of the dollar. So the 1930s is a period of deflation. So in other words, the dollar buys more goods and services, dollars are becoming more valuable, average prices are falling. And what we see is that nominal wages, and again I've indexed them to be 100, in October of 1929, so you see both the solid and the dash in October of 1929 being 100, you'll see the dash line, the nominal wage, stays there. Okay, so so despite the fact that we're now in a depression and prices are falling, no one's really taking a wage cut. And in fact, even as we get farther and farther into the depression, there are very few wage cuts. So as we go out to say mid-1931, the dollar value of wages have only fallen about 3%. But because prices are falling and beginning to fall rapidly, the solid blue shows the inflation-adjusted value of those wages. That's starting to head up. So by the time we're in late 1931, wages are 10%, in real terms, 10% higher than when they were in 1929. So what this tells us is a piece of this puzzle, a piece of this whodunit is, okay, it wasn't that employees were getting these dramatic wage increases. That would seem truly strange. But it seems like something was keeping the dollar value of wages fixed. In the agricultural sector, and I don't have a picture of that because I only have wage data available annually rather than monthly. But if I had that data available, the dashed line would be heading far below, and the solid line would be not so far from 100, maybe at around 95. Okay, so additional piece of the puzzle, in the industrial sector, some factor is keeping wages, the dollar value of wages, very high. And there's an economic force that would tend to push those wages lower, which is deflation and depression, but that's not happening. That's not happening. Why is that? Okay, so let's go back to this whodunit. Who's the source of this labor market failure? Well, I'm going to highlight Herbert Hoover. And it's not going to be him in and of itself, but he played, in my opinion, played a major role. So I'm going to spend a couple minutes and tell you a little bit about Herbert Hoover, his views about labor markets and wages, and more broadly, his views about industrial competition and collusion. And a number of people, some aren't, but a number of people are surprised by this because Hoover's often portrayed as a laissez-faire president, sort of a champion of individual and economic liberty. I think in some cases he is, but not during the Great Depression, and you'll see that in the next couple of minutes. So first let me tell you about Hoover and his ideas about competition, because more broadly, my thesis is going to boil down to a failure of competition, government impeding competitive forces in the labor market and also in product markets, and this is why the Great Depression was so great. So here I have a couple of quotes from Hoover, which I took from his memoirs. And you can see this here. In 1927, as Secretary of Commerce, I wrote the foreword to a bulletin on trade association activities. So Hoover fostered these things called trade associations, in which firms within an industry would get together and share data, and Hoover wanted them to cooperate. Now today we call cooperation among business, possibly collusion and restraint of trade. But at that time, some people, including Hoover, thought, cooperation is a great thing. We'll get together, instead of competing so much, we'll cooperate, we'll reduce waste, we'll increase efficiency. And in fact, you can see Hoover saying things like, the unethical business practices that spring up under the pressures of competition, the great field of economic waste through destructive competition. Now, some of you may understand, may have heard of the term cutthroat competition and chiselers. So my dad grew up in the Depression, and a chiseler was somebody that cut their price. And it sounds like somebody that's doing the wrong thing. Today, economists almost invariably say competition is a good thing. Consumers get the lowest possible price. Only the most efficient producers survive. Back in the day here, that wasn't the way they saw things. Too much competition was a bad thing. There should be some industrial cooperation. And at that time, the FTC studied a number of these trade associations, included there was enormous collusive activity and restraint of trade. The late 20s and through the 30s are sort of known as kind of the high tide of lack of competition in the U.S. economy. This is a view held pretty broadly by legal economists. Okay, so Hoover didn't like too much competition, liked cooperation among businesses. What about wages? So I took a quote here again from Hoover's memoirs, and this pretty much sums it up. Hoover liked high wages, and we all like high wages, both individually and as a society, but for different reasons than Hoover. As economists, and as many of you in the room, maybe who aren't economists, can figure out, a highly productive society with highly skilled workers with very efficient technologies is going to have high wages because those workers add a lot of value. Hoover kind of had it reversed. And it wasn't just Hoover, a lot of people felt this way at the time. They thought, well, gee, if we could just somehow get wages higher, people would have more money to spend on things and more stuff would be produced. Well, that sounds kind of good, and you can imagine at that time it may have sounded very good. But they didn't really think about the flip side of that equation, which is, yeah, if I have a high salary, that's good for me, and it's good for the merchants who I spend my salary on. But what about the people that are hiring these high-wage workers? Well, they're not going to hire very many if wages are too high. Well, not what would happen to McDonald's if the minimum wage went to $500 an hour. There would be no more McDonald's. They couldn't afford to stay in business. That might be a good thing. That might be a good thing. I'm proud that my children have never been to McDonald's, so I agree with that. No, we've tried to stay away from fast food. Not always possible, but that's another story for another day. But Hoover just kind of had this alternative idea. And so Hoover had this view about wages. He supported various types of legislation that tried to promote wage growth. And when I talk about excessive wage growth, I don't mean to begrudge anybody wage increase, but rather the inefficient act of raising wages above underlying productivity. So the Railway Labor Act was an important act in the late 1920s along these lines. The Davis-Bacon Act was an important unionization act. And the Norris-LaGuardia Act was perhaps the most important piece of labor legislation aside from the original Wagner Act and the National Labor Relations Act. And I'm going to focus a little bit on this thing called the Railway Labor Act. Many of you may have not heard of this. I never heard of it until I started doing this this research. Yeah.
Were these all during the Hoover administration, those acts?
The Railway Labor Act was in the late 20s. It was. I'm going to talk about this in a second. So let me go ahead and talk about this bullet point. And if I haven't answered your question, let me come back to that. So the Railway Labor Act, I believe, was in 27. So this is before Hoover, but the Railway Labor Act allowed for independent unions among railroads. Not surprising, railroads weren't very happy about this, and it went through a series of court challenges. What's really important about the Railway Labor Act is that there were an entire series of court decisions that not only upheld the Railway Labor Act, but that substantially and permanently changed rules regarding unionization and strikes and the interpretation of the Clayton Act. What I mean by that is before the Railway Labor Act and its legal challenges, the Clayton Act was interpreted in such a way as to make it almost impossible to do new union organization. In many cases, it was impossible to do almost anything other than stand a few blocks away from the work site and hand out pamphlets. Literally impossible to organize unions. This all changed, not only with the Davis-Bacon Act, the Norris-LaGuardia Act, but it really changed with the court decisions upholding the Railway Labor Act. And in fact, the American Economic Association, the major organizational arm for the economics profession, has a journal called the American Economic Review, one of the most important journals in economics. And in, I believe it was in 1930, the lead article was actually about the Railway Labor Act and how it's going to permanently and substantially change labor relations in the United States. Does that address your question about the timing? Yeah, Norris-LaGuardia was 32, and Davis-Bacon, I think, was around that same time. Yeah, both of these two were under Hoover. Yeah, he signed both of those pieces of legislation. Okay. So now I'm going to get to the point of, okay, so who done it? Herbert Hoover, how did he do it? Okay, well, after the stock market fell in October of 1929, Hoover organized a series of meetings with major industrialists and also with major labor leaders. And these are essentially quotes that I took either from Hoover's memoirs or from an article that was kept by his Commerce Secretary. And he said, don't cut wages. This will help me keep the peace with labor. This will prevent strikes. This will prevent industrial strife. He also said, share work among your workers as much as you can rather than engage in layoffs. And business said, okay, we'll go along with this. And some of the people there, these are the big companies, GM, Ford, DuPont, U.S. Steel. Small businesses are much more important today in the U.S. economy. In 1929, there was enormous concentration. About half of the country's non-residential productive capital stock was in corporations that were controlled by about 1,000 families. So there's enormous concentration, both wealth concentration and concentration of industrial activity. These are some of the biggest firms, and they were indeed very big. So they said, yeah, okay, we'll do this. We'll go along with your idea that we shouldn't cut wages. And then Hoover met with organized labor and said, please don't strike. These guys are going to keep their wages high. Okay. And to the extent that, that we can tell from various contemporary accounts and from interviews with workers, interviews with businesses, both sides kept their pledge. Now, what happens when you keep the dollar value of the wage fixed but prices fall? Well, the real wage goes up. But not only did prices fall to raise the cost of labor to business, productivity also began to fall. So there was really what I'll call a double whammy in terms of increasing your labor cost to firms. Deflation combined with fixed dollar wages raised real wages, and that really hurt firms when productivity fell. So we start seeing the cost of labor to firms going up substantially. And standard economics is going to tell you when labor costs go up a lot, real wages go up and productivity falls, they're going to lay people off or they're going to cut their hours. Now, as we saw, let me just go back to that picture I showed you a couple of minutes ago.
That's not productivity per hour worked at Smalley. It's productivity per dollar spent.
No, this is output per hour. So this is worker productivity.
But that's output in dollar terms or in physical terms?
No, this is physical terms, yeah, real value. So now, as you see, we get into the Depression, 1930-31. I mean, this is obviously a bad situation.
Excuse me, and you will talk about the causes. You've talked about the causes of regulation and stuff causing the fact that the real wages were going to stay up. Who were the things that, are you going to talk about the reason productivity rate fell?
Yeah, my take on, okay, go back here. So my take on the decline in productivity is that before 1929, when recessions came along, the way firms dealt with layoffs, or the way firms dealt with declining demand, is to simply lay off some workers. So if it's this row right here, I might cut everybody's hours by 10%, or I might take 1% of the workforce. Always, they would take 1% of the workforce rather than cut everybody's hours. I'm going to interpret that as being more efficient than trying to cut everyone's hours because of various complementarities in the workplace. In 29, remember Hoover said try to share work. In the 2021 recession, there was essentially no work sharing. And I'm going to interpret that as being as a relatively efficient arrangement for the firm. They could have cut hours across the board, or they can selectively remove some people from the workforce. They would selectively remove some people from the workforce. In 29, Hoover said, don't do that, share work. So I'm going to interpret that as reducing efficiency. More research is going to need to be done to understand the contribution of that factor, maybe other factors of productivity. So that's what I can tell you about productivity right now. So during 30-31, as the Depression is getting much worse, industry actually called up Hoover and said, would you support wage cuts that are just proportional to the price drop? So that way the inflation-adjusted wage won't be any higher. It's too high for us right now. And Hoover said no. And in fact, I took this out of, there's a Time magazine article in early 31 that interviewed people in the Commerce Department, and the quote was, Hoover says, if wages are cut, they'll be hell to pay with unions. Okay. So industry kept that wage pledge until late 31. In late 31, there was another meeting with Hoover where industry essentially presented Hoover with something called the Swope Plan. And the Swope Plan was named after a guy named Gerard Swope, who was head of, I believe, General Electric. Naomi's in the back, and she's nodding her head. Okay, I got that right. You can straighten me out if I get any of this stuff wrong. And the Swope Plan was essentially kind of a full-scale cartelization of the U.S. economy with guaranteed minimum prices and a minimum level of rate of return for profits. And Hoover looked at it and said, you know what? This looks to me like fascism, and my Attorney General told me it was unconstitutional, so I can't support you. I understand you're not having a good time. I understand that times are difficult for you, but I can't support this. At that time, you didn't see, only at that time, until that time, did you see large industry cutting wages. They cut wages at that point when they understood from Hoover he wasn't going to be giving them anything. So they keep the wage pledge until late 1931. Okay, so I've kind of narratively described what I think is interesting and important about this period as relates to labor market failure. What I next do, I'm not going to go into this in any kind of technical detail. I'll just kind of summarize what I did. I constructed an economic model. It's a pretty standard economic model in terms of consumers sort of doing the best they can given their circumstances and their budgets. They're making choices they're consistent with a well-defined objective. And businesses trying to maximize profits. All those features are typically in economic models, and they're in the economic model I have. There's two sectors in the model. There's what I call industry, which is going to be hit by this Hoover policy. It's going to act like a minimum wage. And there's going to be agriculture, which is not impacted by this Hoover policy. And you can kind of see what was going on in agriculture at that time. There weren't these monolith, enormous corporations running farms. They were much smaller. So Hoover never had anything to do with the farming sector at that time. And I interpret that's the reason why farm wages fell and industrial wages didn't. And when I fed in quantitatively this policy into this economic model, it accounts for about 2/3 of the Great Depression. In other words, about 2/3 of the observed drop in gross domestic product and in employment is accounted for by this one policy. And I'll show you.
Excuse me, Lee.
Yeah.
Could you go back to the slide? Maybe you want to discuss this more. It seemed to me you've got two, again, it's a productivity question. You've got two major kind of macro variables. The real wage going up, prices falling as a result of it, and then you have the observed productivity.
Yeah.
And an analysis in your model of that 2/3, I take it that those two variables together account for 2/3
Yes.
of the depression. What did you find was the contribution of the wage price portion compared to the productivity fall portion in producing the 2/3 of the depression?
Right. So I put the two together because what's important from the standpoint of business is to say how much more expensive is a worker? Well, how much more expensive is a worker is going to be their wage relative to productivity. So typically in a business, or at least economic reasoning would tell you, as productivity goes up, wages will go up also because the contribution of a worker increases. When we look at over long periods of economic time, or long periods of time, real compensation and worker productivity move virtually in lockstep. When productivity goes down, wages go down. When productivity goes up, wages go up. So I'm going to put those two together because declining productivity along with higher real wages increases the cost of labor. And from the standpoint of business, that's what's really key. If I take out productivity, if I just kind of artificially say, okay, let's imagine productivity didn't decline, instead of being 2/3, it would be about 40%. So having lower productivity, increasing unit labor costs even more, gets you up from about 40% to about 2/3. But again, from the standpoint of a business, what's really important is, hey, how much more is this person costing me? Well, I'm having to pay them more in the real wages I pay them, but they also aren't producing as much. So that's why I put the two together. So here's a picture, and what this picture shows is the solid blue line is the actual Great Depression, and the dashed line is what the model predicts is the consequence of just Herbert Hoover's policy, along with the coincidence of those higher real wages and lower productivity. And I mentioned, sort of 2/3. So the dashed line is roughly about 2/3 as far down as the solid line. Okay, I'm next going to show you a couple of more figures which compares the predictions of the model to the data. Here's manufacturing hours. And again, what's interesting here is that manufacturing hours, kind of immediately go in the tank. So here's the first quarter of 1930, and businesses have already shed 15% hours equivalent of their workforce. By the third quarter of 1930, we're down 30%. We're down almost close to 50% down by late 31. I mean, this is just an economic disaster. And again, a lot of this is occurring before those declines in the money supply that Milton Friedman would talk about, and before the financial collapse of banks, before the bank failures that Federal Reserve Chair Ben Bernanke's talked about.
Question.
Yeah,
What was the base year that you chose?
1929.
But you show in the fourth quarter of 1929 in both charts that your model does not give the same result as the data. And the model shows less of depression in the data in the
Yes.
fourth quarter of 29.
Right. I say they're equal. Both there is indexed to 100 in the third quarter of 1929.
So you're
Yeah.
indicating a very rapid drop in 1 quarter.
Right, right. So this is immediately severe. Again, this is not the garden variety recession that, the Great Depression is in the news for about the last year because of comparisons to our current economic situation. And, whether it's the New York Times or CNN says, well, the Great Depression started as a garden variety recession, then it got worse because of blah, 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 blah. No, that's not right. It was not a garden variety recession. So this is hours worked in the manufacturing sector. A very, very deep depression, and the model also predicts a very deep depression. Not as much. Other things are going on, obviously. But again, it's about 2/3 as large. Here's the agricultural sector. The solid line is the data. I've adjusted the data for the fact that the farm sector was on trend shrinking over time. As we had 25% of the population on farms in 1929. Today it's 2%. And the model predicts initially an increase in agricultural employment because people faced with the choice of not having a manufacturing job, in the model they can costlessly relocate to the agricultural sector. And obviously in the real world there's all sorts of costs from moving to one industry to another. You might even have to move the location of your home. In the model I don't have those types of details, but then the model tends to say, okay, well the agricultural sector is also going to be more depressed than actually occurred. And this is coming from what economists call complementarities between sectors. Because the manufacturing sector is so depressed, and because manufacturing components are an important input into agricultural production, agriculture becomes less productive. And that's one of the reasons why in the model agricultural has more of a depression than you see, although the depression in agriculture is not as big as in the industrial sector. So what the model tells us is there deep depression? Yes. Is it immediate? Yes. Is it asymmetric across sectors? Yes. Does it account for everything? No, obviously not. It's a simple model and other things are going on in the world. But it does account for those three key features that I find interesting. So Hoover, in my opinion, helped get us into a mess. And not surprisingly, the electorate booted him out in fall of '32 by a pretty large margin. And Franklin Roosevelt becomes president. Okay, well, what happens here? Well, we have the New Deal. And what I'm going to argue now is that the recovery from the Depression should have been much more rapid than we observed. And again, if you've read about these issues in the last year, and if any of you read the New York Times, Paul Krugman's columns have talked a lot about the Great Depression had a very rapid recovery, and Hoover's policies were an important contributing factor to that rapid recovery. Well, I'm going to show you some data that belies the idea that it was a rapid recovery. I'll get to that in a couple minutes. So the first point I want to talk about in terms of Roosevelt is that his themes and his theories about how the economy worked and what would be important for restoring prosperity was not so different than Hoover. It was perhaps a bit more extreme than Hoover in terms of depressing industrial competition and promoting higher wages. And here's a quote from Roosevelt. He said, "A mere builder of more plants, creating more railroads, building more corporations, that's not going to be a good idea. That's what competition would tend to generate." He didn't like that idea. Like Hoover, he promoted cartels and he promoted distorted labor markets. So hopefully you can see these in the back. These are pictures of the top panel shows pictures of real production, which is the solid, and the short dash is consumption, and the broader dash, the one that goes down a lot, is investment, business investment. And these are just U.S. data. I've measured them relative, they're per capita measures, so I've divided by the population. And I've measured them relative to a 2% trend growth rate. And essentially the difference between the kind of pictures you'll see in Paul Krugman's columns and these pictures here is that I believe there's no adjustment for per capita, and there's certainly no adjustment for trend. And when comparing variables across periods of time, particularly long periods of time, and here I'm looking at between 1920 and 1939, you have to correct for the fact that the economy evolves over time. We don't want to compare 2008 to 1908. It wouldn't really make any sense without adjusting for all the trend growth that's taken place. So all these do is just adjust for the 2% trend growth that occurs in the economy and measures relative to the population. And what you see is there's really very little recovery. In fact, there's almost no recovery whatsoever in per capita consumption. See, I don't know if this is, oh, good, okay. So here's consumption. It goes down, and here's 1933, and then it pretty much stays flat. And here's GDP right here. It comes back from about 40% below trend, just an enormous, this is an economic catastrophe, but it's still about 25% below trend by the end of the 1930s. So earlier when I said the Depression is a decade-long event, more than a decade-long event, this is what I mean. What about business investment? Okay, well, it almost goes to zero. It's fallen by almost 80% relative to trend by the trough of the Depression in 33, and it recovers a bit, but is still 60% below trend by the end of the decade. And this is remarkable, if not for any other reason, just the fact that depreciation is taking its toll on the country's capital stock. So the capital stock is falling substantially. So when you read things like, gee, the growth rate of investment was very high, okay, yeah, during this particular period it was high, but it did not get back anywhere close to where it should have been. And standard economic reasoning says it should have been much, much higher. I'll make that more explicit in a few minutes. Okay, almost all the growth in the economy that took place at that time, almost all of it was due to productivity, not the restoration of employment. It wasn't because America put its workers back on payrolls. So this panel down here shows, again, the same time period, the decade of the 30s, and it shows 3 lines. This is the real wages, which I showed you earlier, not for as long of a time period, but I showed that earlier. The solid here is total hours worked, including government workers, and the dash is hours on private payrolls. And some of you are going to be familiar with various New Deal programs such as the Work Progress Administration and Public Works projects, the Civilian Conservation Corps. All those workers, well, they're going to be in this line. They're going to be in the solid line here. They won't be in the private sector line. What I want you to take away here is that there's just not much of a recovery in labor. Hours worked fall about 30%. They come up a bit, but whether you want to include those government workers or not, we're still a long ways away, enormously long ways away from full employment. And again, if you read stories about how, gosh, there was a great recovery because unemployment fell, well, the unemployment rate did fall, but one reason it fell is because there's a lot of work sharing. So we can have 2 folks work, we can have 1 person working full-time, or we can have 2 people working half-time. Same amount of work's being done, we're just spreading it out between 2 people. That type of work sharing was a component of the New Deal, and that's why changes in the unemployment rate aren't as good of a measure of labor utilization during the 1930s as they may be during other periods. This is the measure of labor utilization macroeconomists use hours worked per capita, and it's just not coming back. So those are the facts that I consider when I think about the New Deal and I think about the economy's failure to recover. This last picture I'm going to show you is what I'm calling economic fundamentals recover. And, whoops. What I mean by that is the following. We should have had a fast recovery because remember that productivity decline I told you about? Well, productivity actually comes back quite nicely. This line right here is productivity, again, measured relative to that 2% trend. And what you see is productivity, efficiency per worker falling, But then it comes back in the 30s, and in fact, it gets back up to its trend level. Productivity getting back to its trend level means, according to basic economic reasoning, GDP should be back to its trend level, hours worked should be back to the trend level, consumption, investment. So productivity gets back, but none of the other things come close to getting back. So that was a positive development in terms of economic fundamentals. The picture shows two other pieces. One is deflation. Well, deflation pretty much stops in 1933. So this long dash is the price level. So the average price in the economy falls about 25%, and then we start having some inflation. So for people who think that stopping deflation and getting a little bit of inflation is key to recovery, well, Roosevelt was successful in getting some inflation. Didn't really bring about recovery. This piece here is real bank deposits. There's a decline in bank deposits in the Depression. One reason being the bank failures that, for those of us who've seen, the old movie It's a Wonderful Life with Jimmy Stewart, and the Bailey Savings and Loan, or the Bailey Build, I can't remember, it was the Savings Loan, but the Bailey Bank has a bank run on it. We've all seen that. But what happens? Well, Roosevelt did a number of good things, one of which is he pretty much completely ended banking panics by putting in FDIC, Federal Deposit Insurance. And what happens? Bank deposits skyrocket. So the banking system is in pretty good shape. A lot of deposits available. There's no more deflation. Productivity is very high. Why isn't there a rapid recovery? Okay, well, my answer to that question boils down to some New Deal policies. So in my view, Roosevelt did some good things, but this one wasn't one of them. The National Industrial Recovery Act. So as you go through this, you'll sort of see, well, how could they ever do something like this? So this would be unthinkable from the standpoint of today's economic reasoning. Okay, so this National Industrial Recovery Act, this was the centerpiece of Roosevelt's program to get the economy out of the Depression. Covered about 500 narrowly defined industries. Well, I mean a narrowly defined industry, there was what was called a code of fair competition for the men's socks industry, the live poultry industry. I mean, they were fairly narrow and detailed industries. And the whole idea, and here's where you're going to say, how could they have thought about this? There was not just the implicit collusion under Hoover, there was very explicit collusion in that the Sherman and Clayton antitrust acts were essentially put in the back burner. So the government went to the auto industry and said, Chrysler, Ford, and GM, we want you to cooperate. We want you to raise your prices. We want you to get higher profits. And we're not going to prosecute you for antitrust violations. We want you to have things like minimum prices. Don't cut prices. Don't compete against each other. We think if you do that, we'll stay in the Depression. And in fact, a lot of these codes of fair competition, and kind of ironic, the idea of what's fair competition? A lot of these codes of fair competition had production and investment quotas. I can't put in a new factory or a new office building. It'll give me too much productive capacity. Sort of the classic kind of cartel story that, and UCLA's economics departments, sort of for many, many years under Harold Demsetz and Armin Alch and others, is sort of very famous for understanding how cartels and how collusive behavior really can impact very negatively an economy. Now, industry got these goodies if they increased wages, if they shared some of these monopoly rents, some of these excess payments coming from monopoly, if they shared that with labor. So industry said, okay, and these codes of fair competition were negotiated between industry and labor and the government. And Roosevelt had the authority to impose work rules and a competitive code on an industry if they weren't able to get it together themselves. So what happened? Well, wages jumped. And industry also agreed to collective bargaining. Again, where did this come from? Again, around this time there was this prevailing view that competition was the problem. And a number of Roosevelt's advisors, including a guy named General Hugh Johnson, who was one of the chief administrators of the NIRA, a lot of these people were wartime economic planners and advisors from World War I. And again, this is a kind of a classic case of looking at a particular observation and interpreting it in what economists would call, an error-ridden way. So in World War I, we had an economic expansion, not surprising. Wartime episodes tend to increase economic output because of the emergency of the war effort. But Roosevelt's wartime planners tended to interpret that as, well, gee, we largely suspended the operation of competitive markets. We told U.S. Steel what to do, we told Bethlehem Steel what to do, we told GM what to do, turned Chevys into Jeeps, we told Ford what to do. We didn't have any of this stuff anymore. They didn't compete against each other. So, gee, that was a national emergency. We suspended competition, wages rose, output rose. Wasn't that a great thing? Doesn't this tell us that this model is better than competition? So that wartime episode, they interpreted that as higher output and higher wages coming from economic planning and suspension of competition. And so they thought, gee, if we reduce competition, increase wages today, we'll have another economic boom. Wages will go up, output will go up, we'll be back to prosperity. But again, basic economic reasoning says, no, that's not going to work. What happened on the NRA? Well, in the paper I wrote with my co-author Hal Cole, we looked at these individual industries, and as soon as their codes of fair competition were approved, wages rose 15 to 20%, as did prices. There was explicit collusion. There's no antitrust prosecution. These codes typically had minimum prices, these production investment quotas. Now, some of you know that the NRA ended in 1935. But Hal and I argued in that paper that the policy essentially continued, explicitly on the labor front with the Wagner Act, and implicitly with virtually no antitrust prosecution. And the FTC found enormous collusion and monopolistic practices after this period. Hal and I constructed a model similar to what I just described to you. I'm running out of time, so I'm just going to show you a picture of that. And the picture shows data, and here is GDP from the data. Here's the model. Here's what kind of standard economic reasoning or standard economic theory would tell you should have happened over the course of the 1930s if FDR's policies hadn't been put in place. So if the whole Hoover and FDR legacy, if that was all removed from the economy, we went back to competition. Well, it says we would have gotten back to trend pretty quickly. And that's a consequence of, no more deflation, healthy financial system, bank deposits substantially increased, and enormous productivity growth. Those factors within the view to the confines of regular economic reasoning says we should have come back pretty quickly. Okay, so the last, let me just see. Okay, so the last couple of slides, I'm just going to summarize what I've described so far in the last hour, and I'll tell you a little bit about, what lessons this may have for today. So what I'd like you to take away is just sort of a different view of the Depression. It wasn't this initial garden variety recession that kind of bumped along for a year or two, and then the Federal Reserve made it worse by letting the money supply fall and banks fail. No, it was immediately severe. And what that tells us is something big happened well before those other factors. And then the economy remained depressed long after those factors were corrected. Very little restoration of work occurred, despite the fact that deflation was over and the bank situation was resolved. And again, going back to this whodunit theme, okay, somebody killed the economy, who was responsible? Data on wages and consumption and employment, economists view those in a particular way. That tells us it's a labor market failure. It's a failure of supply and demand to meet up to create a wage that's consistent with a lot of people wanting to work and finding jobs, and businesses wanting to hire those people. Instead, wage rates were way above normal, which means businesses aren't going to find it profitable to hire a lot of workers, but a lot of people are going to say, hey, I'd love a job. I'll even take a 30% wage cut relative to the people you have right now. And what that tells me in terms of the conclusion is the Depression would have been less severe in the absence of the policies of both Hoover and FDR. Okay, what about lessons for today or crises more broadly? Almost every crisis you see, whether it's the U.S. in the 1930s or Japan in the 1990s or the U.S. today, there's almost always what I'll call a political demand for what I'll call a crisis management solution or crisis management policies. What I mean by crisis management policies are policies that try to cushion the impact of a recession and that also protect or bail out important economic or political constituents. You almost always see that. And these policies can, not always, but they can deepen or prolong a recession by distorting market forces and incentives. So I talked over the last hour about the U.S. in the 1930s. What about Japan in the 1990s? Well, they had a sort of people talked about Japan's lost decade. What did Japan do? Well, they, and also Mexico in the 1980s, both Japan in the 90s and Mexico in the 1980s adopted policies that a broad section of economists agree kept inefficient banks and the inefficient customers of those banks afloat for many, many years. So you may have heard the term zombie banks and zombie producers in Japan. Yeah, banks or producers that really had no business being in business, but were kept afloat by these policies. Mexico did the same thing. Japan had a lost decade, a stagnant economy for over 10 years. Mexico had a stagnant economy for 15 years. Sometimes countries don't give in to the tendency to adopt crisis management policies. So Chile is an example. Chile had a similar crisis as Mexico in the early 1980s with a debt crisis. Well, Chile didn't prop up inefficient producers. Chile had a rapid privatization. They had a fairly efficient and rapid bankruptcy proceeding. And Chile had a very strong recovery. And in fact, Chile is the one country in Latin America that you can point to in the last 25 years as one that's had a really successful economy. Okay, so parallels for today. Well, we're not doing the National Industrial Recovery Act or anything like that, but there are some similarities. I mean, over the last year, we've obviously protected and bailed out, almost every major financial institution and 2 of the 3 large automakers. And a number of economists have expressed concern about this because it makes what we call the too big to fail problem and the moral hazard problem associated with that much, much worse. So the next time this comes along, hopefully it won't, but the next time this comes along, if it happened today, we're going to be facing the exact same situation as we did a little over a year ago. We also had a very aggressive fiscal, what I'll call a political fiscal policy response. So the American Recovery and Reinvestment Act, the $787 billion stimulus plan, that a lot of economists had reservations about. It's not clear what type of impact it had on the economy, perhaps very little. So we generate a lot of debt because of all this government spending, and it's not clear whether it, in the aggregate, whether it generated very much employment or not. So the implication from this is that these crisis management policies, they're tough to ignore. They come from politically important sectors and constituents, those that are sort of too big to fail. And this is a huge problem for an economy to confront. It runs into what Edward Prescott, 2004 Nobel Prize winner, talked about, the time consistency problem. I can tell my not quite 3-year-old son, I can tell him, stay in your seat or I'm going to turn off the TV while you're eating your cereal. And he knows that if I turn off the TV, he'll scream loud enough that the TV ultimately is going to go back on. So we can tell Citibank and BofA and GM, we took care of you this time. Next time you're on your own. Okay, they're smart. They know what the time consistency problem is. They know that it's a tough one to solve, and they know that when they come knocking on the door again, government will probably be there. So this is these are some of the most important issues I think policymakers are confronting. And there's, at least to me, there's no really easy solutions to that. More generally, policies that support competition, improve incentives, and ones that are clearly articulated are the ones that will restore prosperity. Well, thank you very much for your indulgence to go 10 minutes afterwards. I'd be happy to chat with you about this.